watching Economic Buzz with Mr. Vicky Amarnani, market strategist, Monex Invest in the Futures, to share his view for the topic that we bring up in this talk show. So, from the news, we know that government is optimism that on economic growth in 2014 will reach 6.9%. Is it really? Is it quite what's so called
achievable target?
I
don't want to say no directly, but I mean 6.9 in my view is too optimistic. I mean, even if you look at developed nations now, growth in the US is expected to be in the 2% range. Global GDP growth is expected to 2 to 3%. And before the crisis, the growth used to be 6%, 7% global growth. So the economy, investors get used to slower growth. And I do not see a harm if growth of Indonesia drops to, let's say, 5%, 5.2%, it's not going to be a big shock. It's still much better than developed nations who are only posting, or in Europe, which has negative growth, or the US, which only has 2% growth. So I think with exports weakening because of slowdown in US, slowdown in Europe and in China, 6.9% would be difficult to achieve. But again, I mean, it's not Indonesia in particular. I think global governments globally, even the Fed in the US, they do not want to create any panic in the market. Because if you put up a very negative statement or a very pessimistic view, you ruin the sentiment of the market. If you ruin the sentiment of the market, people start selling stocks, the currency starts weakening.
Things are getting worse.
There is no liquidity in the market. People cannot borrow. Banks stop lending. We hit Maiden Street. Then we're back to the 2008 crisis. So we can't afford to do that. But according to me, I think the best we would see Indonesia is basically 5.6, 5.7% growth. The economy is deteriorating, but it is no major panic, basically.
Even though there's a correction of the growth, it's not the end of the world.
It's not. It's still a growth, right? Even if you have over 5% growth, it's still growth. The economy is still growing pretty healthy.
Okay. So in a previous segment that you told me that right now the safe haven is no longer gold, it's dollar. So what is actually the thing that maybe investor can do amid this sentiments and whatsoever?
I think in the current
foreign exchange.
Yeah, I think in current correction where equities are dropping, bond prices are falling, some currencies like the Australian dollar is breaking new lows, Indian rupees is also basically weakening at all-time levels, Indonesian rupiah has touched 10,200. Investors may want to do some opportunistic trades, but my suggestion would be you cannot pick the bottom. So to go into cash, and when I say cash, I would preferably say US dollar. That would be the safest cash to be in now, especially if rates are going to rise sooner than expected. The stimulus will reduce. That means, again, that will lead to dollar strength because less printing of money. So try to, let's say if you manage a portfolio and you have 20% cash, maybe now keep 40% cash. Keep a little more cash and look for some opportunistic buys along the way. That would be my suggestion for investors as a whole. In terms of gold prices, physical buyers, go ahead and buy. I think we'll bottom out. I think we could see new lows, but to 1,200, 1,250 levels per troy ounce. I think those are attractive entry levels. And for traders, if you want to buy a bit, don't buy them all now, basically. Or, I mean, if you're a short-term trader, I mean, like these are people who trade online, basically, with derivative products. Gold is definitely on a downtrend. The fundamentals also support gold for a downtrend with a stronger dollar. No safe haven approach for gold anymore. That's gone. The QE is gone. The QE was supporting the gold to strengthen to an all-time high of 1927. So now basically on rebound you sell gold, but physical buyers who have views of 2 to 3 years buy gold. It will eventually go up.
So we're going to have a last segment after the break. Yeah, make sure that you're still with us. We still have one more segment on eBus talking about rebuilding the capital market confidence.